All week long, we've been talking about what you need to know to prepare for tax season. It's a lot of work, and now we're answering your questions. With me now, a panel of experts and some of my favorites. Dominic Tabella, the president of Diversified Private Wealth Advisors. Mattie Duppler, the budget and regulatory policy director for Americans for Tax Reform. And Rich Coppa, a managing partner at Wealth Health. Okay, we have got a ton of questions. We're just going to get to it. I'm going to start with a question from Twitter from Mark Santoleri. He says this: can a college student being claimed by their parents file their own federal income tax return? Mattie?
No, but I would warn him if he doesn't get health insurance and doesn't get it through his parents, they will be liable for his individual mandate tax under Obamacare. So if he doesn't want to give mom and dad more grief, make sure he takes care of that as well.
I don't even think you have to pay the mandate tax anymore.
I
mean, because
you might not.
There's
Who knows what the president's going to do?
Any excuse.
Yeah. But the college kid may want to file a tax return if he worked and had withholding and can get a refund. So we have lots of clients that we advise the college kid to file, if you want a refund, and you shouldn't have been withheld, then you need to file that tax return.
I love that. Okay, Don, that leaves you with this next one from Michelle in North Carolina. In the past, my husband hasn't been too fond about setting money aside for health expenses because they don't roll over to year, and we're healthy, so we don't use all of our money for that. But this year, the health savings account seems to have some changes that might have some real tax advantages. Don, what do you say?
So the good news is that if you have any balances left over in your account, that does get to roll over until the following year. The bad news is that if you're looking at a self-employed individual, an entrepreneur, you need a trustee to hold this account. So there's going to be, first you got to find one that's willing to do it, and second of all, there's going to be an expense in having that, just a bank, an insurance company, a brokerage company. So you have to look at the expense of that and see if it's worthwhile.
All right. You wanted to pile on here, Rich?
Of course I want to pile on. Just for clarification, because when you read that question, I think there's a lot of confusion sometimes between an FSA, which is a flexible spending account, and an HSA, which is a health savings account.
Totally right.
Flexible spending is a use it or lose it. You put money away pre-tax dollars, you have to use it by 2.5 months after the calendar year. Otherwise, it goes back to the employer. Health savings account, you can roll that over, and that has to be matched up with a special health care plan.
You know, it is just so tediously complicated. They make it so hard.
And Obamacare made it more complicated, ruling out some of the things you used to be able to pay for with your HSA. You can't anymore. Over-the-counter prescription drugs being one of them.
They're just not as attractive as they used to be. Here's Ken in Virginia with a question. Is the administrative management fee paid to a financial service company for servicing a traditional IRA account? Is that deductible?
Well, it depends on where it's paid from. So if, in fact, the administration fee was paid out of the IRA account, it is not deductible. It came out as pre-tax dollars. If, however, you pay it from a taxable account, absolutely it's deductible, but of course it's subject to the miscellaneous deduction rules, has to exceed 2% of your AGI.
Dominic, I want you to start on this one. This is from Richard in Pennsylvania, who says, I'm not able to itemize deductions, but have what I feel is a very unfair dilemma. One of my poorer choices has caused me to lose about $10,000 this year. During the latter part of the year, I was lucky enough to win one of those small jackpots the casino pays by hand. The small win causes me to continue to be way behind in the loss column, but I am required to add this to my win, to my taxable income. Is that correct? Dominic?
So this is actually a two-part question. So any winnings from gambling are considered ordinary income, and you can only use gambling losses to offset gambling winnings. Having said that, it sounds like he had a capital loss, maybe short-term, maybe long-term, but he would be able to use $3,000 of that capital loss this year against ordinary income, and then anything he couldn't use would get rolled over into the following year. So it sounds like he needs a little help in figuring out what kind of income he's got here.
All right.
I was just going to say that I think the issue, too, the taxpayers asking whether or not the losses can be, are they just kind of gone because they're taking a standard deduction? And the actual answer is yes, because if your standard deduction is greater than itemized losses or itemized deductions, which would include the gambling loss, you're getting the benefit anyway because you have a larger deduction by taking the standard. So do the math. If your itemized deductions with the gambling losses is in excess of the standard deduction, take the itemization.
Maybe you need fewer gambling losses. That was my view.
Start there.
Joe in Connecticut has this question. What is the marriage tax penalty? Mattie?
So filing jointly is really meant to accommodate families where one parent is working. So the marriage penalty comes into play when you have combined incomes that push you into a higher tax bracket. Now, this works against several different types of taxpayers. One, though, is a low-income taxpayer who, when they combine their income with their spouse, may then not be eligible for something like the Earned Income Tax Credit. But, of course, on the higher side of income, if you combine your income, you know, the deductions that you normally would take don't necessarily double. So something like the child tax credit wouldn't be double what it is for individuals as it is for couples. So that's something that causes a concern for taxpayers on the higher end as well.
All right, marriage tax penalty. Let's take one from Anna, California, who asks, I have an IRA and 401k. Since I've been unemployed in 2013, have not contributed to any or withdrawn any money, how will I be affected when I file my taxes?
I don't think there's a taxable event here. I mean, just the fact that she's unemployed, to me, is regardless of whether you've contributed or taken any withdrawals from your 401k or IRA. If that has not happened, you haven't made contributions, you haven't made withdrawal, there's no taxable event.
What if she's hit that age where you have to take money out?
If she's 70 and a half and she has to take money out, then yes, that would be taxable income to her. And if she's unemployed, I don't know if she's getting unemployment income, but that too may be taxable.
That's the downside right there.
Yeah.
Tom.
Jerry, this brings up a good planning tool, though. If you have somebody who's unemployed, and particularly over age 59 and a half, you might look at obviously withdrawing some of this income out and being at either no tax bracket or an extremely low tax bracket. So that's a planning tool that we could use to get some of these taxable dollars out, and either pay very little taxes or none at all.
I want to squeeze one more in with Mattie quickly. Robert in New York asks, has the estate tax law changed in 2013?
It has. Coming from the fiscal cliff in 2012, we were looking at 35% death tax, as we like to call it, because that's what the event is that we're taxing. But now we're looking at 40% with a $5 million deduction. So that's, $5 million exemption. And so that's much better than the law would have been. Had we not come to a deal in 2012, it was going to go up to 55%.
Yeah.
That was not enough tax advice for me. I want more tax advice. You guys are great together. And we had two of you on set. How good does this get?
That's great.
It doesn't get any better than this, except a month from now, we don't talk about this anymore.
Until next year.
But you know what? We've really got to focus on it now, let me tell you.
Right.
There's so much to do. Mattie, Dominic, and Rich, thanks for coming on the show tonight. You guys did a terrific job. Thank you so much.
Have a great day.
Thank you. Have a great weekend. Well, time now.